Greetings to all my beloved students. So in this recording, I will be answering the 2023 main exam paper. So this paper was written by students who are doing advanced diploma in financial management. So the name of the module is long-term financial management. So the paper was written by students who are enrolled at REGENT Business School. So let us go to the first question. So we're going to do all the questions. So as you can see here, the paper was written on the 10th of November 2023, and students were given 3 hours to finish or to submit the exam, and then the paper was out of 100 marks. So now let us go to question 1. So before we read the information provided in the question, let us first read what is it that is required of us. So here we have required section. So we are required to calculate the cost of 1.1 ordinary shares, that is the cost of equity. 1.2, the cost of preference shares. 1.3, the cost of debt. So we're gonna do 1.1 up to 1.3, and then after that we're gonna go to 1.4, whereby we are required to calculate the weighted average cost of capital work using your answer from above. So guys, we already know what is required of us. So now let us read the information that is given in the question. So guys, this question is out of 25 marks. Information containing the capital structure of Brexit Finance Company is as follows. So here we are given the capital structure with the market values. So we have owner's equity, which consists of ordinary shares, which is having a market value of 4.5, preference shares with a market value of 1 million, and we have long-term debt, which consists of debentures at a value of 3.5, market value of 3.5 million. And we have additional information. So the first bullet reads, the current risk-free rate is 7.25%, while the current market portfolio return is 12.2%. The company's beta is 1. So guys, we're going to use this information to calculate the cost of equity. Remember, during our live lesson, I told you that there are 2 ways to calculate the cost of equity. So this is KE. So cost of equity can be calculated in 2 ways. So the first one is CAPM. So we can calculate the cost of equity using the capital asset pricing model, and we can calculate the cost of equity using DGM, which is dividend growth model. So the formulas, guys, are not the same. So if we calculate the cost of equity using CAPM, we use the formula KE. So this is the formula that we use. KE is equals to RF, which is risk-free. So it's RF plus company beta into RM minus RF. So RM minus RF. So guys, we use this formula to calculate the cost of equity. So, and then the second formula that we use under DGM is KE equals to D1, which is the expected dividend, divided by current share price, PO, denoted by PO or P0, plus the growth rate plus G, which is the growth rate. So guys, you can use both formulas to calculate the cost of equity. So now you're going to check the information that is presented to you and see which formula is applicable. So now when we read here, we can see that we have free risk, we have market return, portfolio return, and we have beta. So obvious, based on the information that is given in the question, we cannot apply this method. We cannot apply DGM, because for you to apply DGM, you must be given current dividend, growth rate, and share price, which in this question we are not given. So now in this question, we are given the risk-free, beta, and market return. So meaning the applicable formula is, or method is, the first one here, CAPM. So we're going to use this one to calculate CAPM, because the information that is provided to us allows us to use this model, CAPM. So now it's simple, guys. We already know the formula. So we already know the formula. So I want to do my workings here. So this is where I will do my workings. So we are calculating the cost of equity. So cost of equity equals to risk-free rate. So the risk-free is given in the question at 7.25. So the risk-free is 7.25. The market return 2.2 and beta is 1. So we're going to use this information. Okay, so the cost of equity, or you can say cost of ordinary shares, is equals to, so RF is given at 7.25% plus the company beta of 1 into RM. So RM, that is the market return or market portfolio return, which is given in the question at 12.2% minus the RF risk-free, which is 7.25%. So now from here, you can just punch your calculator, but let us do it step by step. So we have 7.25% plus. So now you can just punch this in your calculator. So you remember we follow both maths. We first work out the bracket. So you're going to take 12.2% minus 7.25%, which will give 4.95%, and then you multiply by 1. So anything multiplied by 1, so I'm going to effect. So we're going to have 4.95%. So now we combine or we add the two rates. So 7.25% plus 4.95%, I am getting 12.2%. So this 12.2% is the cost of equity. So guys, we have done 1.1. So this is 3 marks. So 1.1. And now we are moving on to 1.2. So for 1.2, we are required to calculate the cost of preference shares. So how do we calculate the cost of preference shares? So cost of preference shares, that one is denoted by KP. So KP, that is the cost of preference shares. So the formula that we use is preference dividend divided by share price. So P, that is for share price. So we divide by P. So now let us do our workings. So we are doing a calculation for 1.2, cost of preference share. So now we need to go to additional information bullet 2. So let us read the second bullet of additional information. So here we are told that the preference share capital was issued at 5 rand per share. So 5 rand is the nominal value or issue price. An annual 10% dividend is paid at the end of each year. So annual dividend is calculated at the rate of 10%. So to get the dividend per share, we're going to use the share price, or we're going to take the issue price multiplied by 10%. So issue price per share times 10%. So that will give us dividend per share. And the shares are currently trading at 5.50 rand per share. So 5.50 rand is the current share price. So this will be our denominator in the formula. So now let us do our workings here. So we said in the numerator, we disclose the dividend amount. So how do we get that amount? We take 5 rand, the issue price times the dividend rate of 10%. So 5 rand times 10%, that is 50 cents, meaning the company is paying 50 cent dividend per share. So 50 cent is the dividend per share. So we're going to divide this by the share price. So current share price is given in the question at 5 rand 50. So now you just punch this. Let us first work out the numerator here. 5 rand times 10%, that is 50 cents. So we have 50 cents divided by 5 rand 50. Then we use the calculator now. So 50 cents divided by 5 rand 50 multiplied by 100, so that we get a percentage. So on my calculator, I'm getting 9.1%. So 9.1% is the cost of preference share. And then 1.3, we are required to calculate the cost of debt. So 1.3, they want us to calculate the cost of debt. So the formula here, So to get the cost of debt, which is denoted by KD, you take your interest rate before tax, you multiply by 1 minus tax. So T represents the tax rate, and then I represents the interest rate before tax. So now let us read additional information on the third bullet. So bullet number 3. Debentures due in 7 years with a before tax cost of 10%. So we are given the before tax cost of these debentures is 10%. So we're gonna calculate the after tax cost of debt. So we already have our formula here. So now we are just substituting. So our I is the cost of debt that is before tax, which is given in the question. So it's 10% multiplied by 1 minus, do we have the tax rate? So we should be given the tax rate in the question. So in the last bullet, we are told that the company tax rate is 28%. So we're gonna apply that rate, 28%, which is the tax rate. So we are removing the tax effects. Then, guys, now it's simple. You just punch this in your calculator as it is, and remember to multiply by 100 so that you get the rate or the percentage. So in my calculator, I'm getting 7.2%. So now we are done with 1.1, 1.2, and 1.3. Now we are going to 1.4. So for 1.4, we are required to use the table below and the given market values of every form of capital to calculate the weighted average cost of capital work using your answers from above. So the answers that we have calculated for 1.1, 1.1 up to 1. From 1.1 up to 1.3, we're gonna need them in this table to to compute the work calculation. So now in this table we have the capital source inserted for us. We have ordinary share. So ours is to disclose here the market value, which is given in the question. So the market value for ordinary shares is 4.5, for preference shares 1 million, and for debentures 3.5. So these are market values that we're gonna use. So we're gonna use these market values to determine the weight. So for ordinary shares we have 4.5 million, and for preference shares we have the market value of 1 million, and for debts we have 3.5 million. So now, guys, we need to get the total. So now we must total up these market values. So we're gonna add these three values. So 4.5 plus 1 million plus 3.5. So the total is 9 million. Why do we need this total? So I will explain just now. So we need this total to calculate the weight. So now we want to get the weight. So how do we determine the weight? So the weight for ordinary shares, we're gonna take 4.5 million divided by total of 9 million and then multiply by 100, because these weights must be presented as a percentage. So that is why we need them. So now we're gonna take 4.5 divided by 9 million times 100, and that is half. So obvious, the rate here will be 50%. And then for preference shares, you take the market value of 1 million, you divide by 9 million. So remember to round your answer to the nearest whole number. So I'm getting 11%. So I'm rounding to the nearest whole number, guys. So I'm not taking decimals. And then the weight for debt, you take the market value of 3.5, you divide by the total of 9 million multiplied by 100, and I'm getting 39%. So guys, now remember that your weight must always add up to 100%. So your weight must always add up to 100%. And then in the next column, we have cost, which are also presented in as a percentage. So all these costs have already been calculated. So we have the cost of equity. So the cost of equity that we calculated in 1.1, we got 12.2. And then the cost of preference shares that we calculated in 1.2, we got 9.1. And the last one, which is KD, cost of debt, we got, the one we calculated in 1.3, we got 7.2. So we have 7.2. So now, guys, remember to get the weighted average cost of capital, you take your weights and multiply it by the cost. So now To get the work for ordinary shares, we're going to take the weight of ordinary shares multiplied by the cost of ordinary shares. So 50% times 12,2. So that gives us 6.1%. So 6.1%. And then we do the same for preference shares. You take 11% times 9.1, and that will give 1%. And the last one, for now we are calculating work for debt. So you take 39% times 7.2, and I'm getting 2.8%. 2.8%. So now we're gonna add all the three so that we get the work, the required work, weighted average cost of capital. So 6.1 plus 1% plus 2.8%. So I'm getting 9.9%. So guys, this is our work, weighted average cost of capital. So by so doing, you have earned yourself 25 marks. So guys, I hope you understood this question. So if you have any question, feel free to, to send me a message, or you can comment on this video, and I will make sure that I address all the questions that will be asked by students. So thank you, and see you in the next video. Goodbye.